Hello, and thank you for joining us for our second quarter market and economic update. My name is Jason Gunkel, and I lead our investment team here at Syverson Strege. I have good news to share that the market had quite a turnaround in the second quarter, and it turned out to be one of the strongest quarters that we've seen in years. The S&P 500 gained roughly 15%, its best quarterly performance since the 2020 post-pandemic rebound. And the technology-dominated NASDAQ 100 had its second best quarter in the last 25 years, up about 21%. However, the quarter didn't start out that way. Markets carried some volatility over from the first quarter in April, tied to the conflict with Iran, which sent oil prices sharply higher. But as that situation began to ease a bit and corporate earnings came in strong, the market rally broadened out. Year to date, the S&P 500 is now up about 10%, and international stocks are up nearly as much, over 9%. The emerging market stocks are leading the way, up nearly 24%. As interest rates have risen since the beginning of the year, they have weighed on bond prices, and bonds are only slightly positive for the year. Inflation data, which was reported with a lag, kept climbing during the quarter, even as oil prices were falling. Headline CPI was 4.2% year over year in May, and that was the highest reading in 3 years, largely because energy costs from earlier in the quarter were still working their way through the numbers. Energy alone accounted for more than 60% of May's price increase. Falling oil prices will hopefully start showing up as relief in the inflation data over the summer. Mostly due to the higher inflation numbers, bond yields have moved meaningfully higher this year as well. The 10-year Treasury yield climbed to a one-year high, nearly 4.6% in May, driven by the higher inflation scare from oil and a more hawkish tone out of the Federal Reserve. The 30-year yield touched its highest level since 2007, and as a result, mortgage rates continue to stay above 6%. As a reminder, bond prices move in the opposite direction of yields. So this rise in yields has meant falling prices for existing bonds. It's been a tough stretch for fixed income, particularly for longer duration bonds, and a good reminder of why we think carefully about duration positioning in our client portfolios, and we are currently favoring high-quality, shorter-term bonds. One of the biggest stories of the quarter has been a change in leadership at the Fed. Kevin Warsh took over as chair in May and quickly shifted the tone, refocusing on the Fed's 2% inflation target and pushing back on expectations for rate cuts. For most of the quarter, the market essentially priced out any chance of a rate cut in 2026 and began pricing in the possibility of a hike instead. However, the Fed is also closely watching economic growth. Just this past week, softer than expected jobs data nudged market expectations back towards a possibility of a rate cut later in the year. With all that being said, the most likely scenario is that the Fed won't move rates significantly over the next 6 to 12 months. For much of the first part of 2026, value stocks led the market. Energy companies were benefiting from high oil prices, and investors were cautious about high valuations and mega cap technology stocks. That reversed in the second quarter as growth stocks came roaring back, powered almost entirely by AI stocks and the semiconductor sector specifically. So while value still holds an edge in parts of the market, for the year overall, growth was firmly back in the driver's seat in Q2. However, this growth stock rally is increasingly being driven by AI infrastructure and semiconductor companies, not strictly the Magnificent Seven mega cap stocks that dominated the headlines the last several years. In fact, several of those 7 stocks have had a rough year, with some down significantly and their average return only about 3% year to date. The other headline event of the quarter was SpaceX's long-awaited IPO on June 12th. Its share price quickly jumped, pushing SpaceX's market cap above $2 trillion and instantly making it one of the largest public companies in the world. It's worth putting that number in context, though. Unlike most other companies in that trillion-dollar club, SpaceX isn't even profitable, and its revenue is a fraction of what you'd see from peers with similar market values. Trading at an astronomical price-to-sales ratio above 100 compared to the market average of only 3. It's also a good moment to remember a well-established pattern in market history. Newly public companies, on average, tend to underperform the broader market in the months and years following their debut. Excitement around a listing doesn't always translate into sustained outperformance once a stock has to trade on fundamentals, like everything else in the market. Underneath everything we've covered, corporate earnings have genuinely been excellent and have largely justified the growth in the stock market. Analysts expect Q2 S&P 500 earnings to grow around 23% year over year, with revenue growth at its fastest pace since 2022. Energy and technology have been the biggest contributors to that. In summary, this market is still very much being driven by AI. It's fueled an enormous amount of the gains that we've talked about today, and it's likely to remain a major force in the months ahead. But what we want to make sure is that your portfolio isn't overly concentrated in any single theme, sector, or a handful of mega cap stocks. We're keeping you diversified across other areas of the market, including small and mid-cap companies and international stocks, many of which have quietly kept pace or outperformed this year without the same valuation risk. As always, our investment team will continue to monitor the quickly changing market and keep you informed. Thank you for your continued trust in us and for listening today. We look forward to meeting with you soon and talking about your investment portfolio. Take care.